I'm back. This isn't about the gold standard. This isn't about whether or not we should go back to it, how puggies it was, or how based people making decisions about monetary policy are or aren't. There are much more knowledgeable people who actually care about economics that have covered those topics to death. And to be frank, I'm not that guy. Or Frank. Finance gives me the creeps, and what I wanted to find out and want to convey here deals in shades of gray beyond gold bad or interest rates do whatever it is that they do, therefore, whatever. My question, a yes or no setup with its non-answer that will probably drive some of you absolutely insane, has very little to do with picking a team in a debate that for all intents and purposes has been a solved game. All I really want to know is, did dropping the gold standard lead to an increase in financialization in the United States? Because I read a sentence in a philosophy book about financialization and globalization in the 70s, and after a short conversation with my dad, I decided this was a question I needed to answer. If you do want a video that answers whether or not the gold standard is something we should return to, Economics Explained has an excellent one diving into exactly that. Beyond pointing at the screen shouting, "I know where he got those pictures," when they talk about Bretton Woods, I lack the depth of knowledge to answer that effectively in this video before ultimately moving on to my main point. For those of you that have been irreversibly corrupted by TikTok, the answer to my question is kind of. As unsatisfying as that answer is, imagine setting out in mid-October thinking you could find a yes or no answer by January, because the holidays would set you back a few weeks. It turns out that economists are interested in the things that make my eyes glaze over when it comes to dropping the gold standard, and I got stuck trying to find my answer from that. The closest I got was a combination of an article by Lawrence H. White titled "Experts in the Gold Standard" and a survey put out by the Kent A. Clark Center for Global Markets. White proposes a simple idea. Economists today instinctively oppose the idea of the self-regulating gold standard because they have been trained as social engineers. His idea goes a bit beyond this half-a-sentence quote, obviously, and while White was arguing for the gold standard, he also points out that economists are unincentivized to study any alternative to the current fiat system, as if they find one that doesn't need them, then they'd be out of a job, in a bit of a callback to an idea of Milton Friedman. Supporting this, if you go through the survey by the Clark Center and just quickly pop into the Wikipedia page of each of those economists, an overwhelming majority who vehemently oppose the return to a gold standard served in high places making important monetary decisions. Intriguing, but like I said at the start of this video, this isn't about the gold standard. Monetary policy is a part of financialization, and while these together could get us to kind of, it felt like it could be right, but it lacked supporting sources and context. This wasn't quite the kind of that I was looking for. So if I wanted to find my answer, luckily, I'd have to leave economists behind and find out more about financialization. But before we get into what the experts have to say on it, let's define it. Merriam-Webster well, shit. The dictionary isn't going to help us define financialization, so let me take a crack at what it is. My narrow-minded inclination to dislike the growing number of business majors? That's not financialization. More seriously, a growing financial sector as a part of GDP, that is financialization. Businesses focusing on shareholder value and, to an extent, private equity, just in general, that's financialization. For those of you older than me or a bit more learned on the topic, the Timken Company cutting off its ball bearing arm, that's financialization. As you may have guessed, when the dictionary doesn't define it, it's a bit of a broad term. Financialization, causes, inequality consequences, and policy implications, states, financialization goes beyond the financial system and distorts income distributions, job creation, and investment throughout the economy. So it's hard to talk about financialization in a purely economic way. You can't just say that a larger and larger financial sector is a part of GDP is an adequate definition, because when you use financialization as a term, it can label far more than some kind of GDP market share. So What is it about dropping the gold standard, or to be the best kind of correct, technically correct, dropping Bretton Woods that brought on financialization? What has me confident enough to publish a video with the answer that the two are kind of linked? After all, Capitalist Realism by Mark Fisher came out in 2009. The Occupy Wall Street movement took hold of the media when it began in 2011. This came out in 2013. Conversations about income inequality, our focus on private equity, number go up memes, and talk of shareholder value is a relatively new trend. Sure, it took hold of public consciousness over a decade ago, but that decade is a far cry from the over 50 years ago that Bretton Woods fell. So how is it even kind of related to the ills we talk about today that I'm calling financialization? Like other things that one percenters enjoy, like fine wine and fancy cheeses, financialization took time to age and come into its own. Trends that led to its effects being talked about today are measured from the late 1970s. To quote my only source again, among earners, the US is now one of the most unequal countries in the world, with its inequality level rising since the late 1970s, and now comparable to that of China. Again, finally, and perhaps best known, is that a disproportionate share of all growth in national income since the late 1970s has been collected by the top 1% of households. Sure, this at least brings us into the right century, even the right decade, but it still doesn't close the gap all the way to 1971. That all-important year when we could dig the gold out of our backyards and flaunt it again without FDR peeping over the fence to see what we're doing back there. To quote yet again, while tight monetary policy stabilized the income of the finance sector by taming inflation, it was deregulation that fundamentally shifted the basic structure of the economy to favor the financial sector. The crux of my kind of comes down to the second part of that quote, that now, in a fiat system, constraints that previous systems had were shed and deregulation was encouraged, or at the very least, became an avenue to be explored. I took a bit of chance with the lead author of the paper I've incessantly been quoting, Donald Tomaskovic Devi, and I'm sorry if I'm pronouncing that wrong, and shot my shot with what I had learned so far, and just asked, in your opinion, did the end of the Bretton Woods system help create an environment that sped up or incentivized the deregulation in the 1980s and 90s? The response is what makes me comfortable saying kind of. After his explanation of Bretton Woods, he responded with, financialization begins in the late 70s and was propelled by the same loss of US manufacturing dominance and a new free market policy ethos. There is some debate if that free market framework came from economists as expert advisors on policy versus large private sector firms trying to solve the trade problem by reducing labor and regulatory costs. Now, considering this is not a formula or engineering principle, my mind took "there is some debate" to mean that there is probably a little bit of truth on either side of it, leading me to kind of. That, and in The Financialization of the US Economy, or How the Reagan Administration Discovered Global Capitalism, Greta Krippner writes, Eric Helenier has noted, the integration of the US economy into global financial markets in the post-Bretton Woods era underwrote the policy autonomy of the US state at several critical junctures. Again, that reads to me as a big ol' kind of. And if that's what you came for, feel free to like and subscribe. Comment to tell me how wrong I am, and I'll see you again next year. But for those of you that are a tad more curious, those of you who wonder, what kind of deregulation are we talking about? I read abundance in... Who are we kidding? I listened to Ezra Klein talk about abundance on 2 or 3 of my podcasts in March, and I'm a bit more discerning about my ideas about deregulation now. What do you mean? Folks, I am so glad you didn't ask, because there's a good deal more context here that our kind of is still missing. To start, Professor Tomaskovic Devi, in his email response I shared earlier, says about the late 70s that it was propelled by the same loss of US manufacturing dominance and a new free market policy ethos. But what were those events? Paul Volcker. Old Paul Volcker, chairman of the Federal Reserve in the Carter-Reagan times, was real serious about bringing down inflation. People were sick of having it in the 70s, and he was going to make damn sure it wasn't going to come back. He was so serious about raising interest rates to make sure that inflation wouldn't come around these parts, they named his wild raising of interest rates and subscribing to monetarism. That's controlling the money supply. The Volcker Shock.
Old Paul Volcker.
I'm gonna be a bit more dramatic and simplistic than this was. But what Volcker or the Reagan administration didn't realize was that those crazy high interest rates really appealed to foreign investors, driving up the price of the dollar, which was cool and all, but it made exporting goods a good deal more expensive. Thus began the death of the Rust Belt and the rise of financialization. To quote from Professor Krippner again in 2003, as capital came pouring into the United States, the dollar began to appreciate rapidly. In order to invest in the US economy, foreigners had to exchange their currencies into dollars, with the result that demand for the dollar increased, driving up its price. This, in turn, placed American exporters at a competitive disadvantage in foreign markets for the reverse reason. In order to sell in those markets, exporters converted dollar prices into local currencies. Thus, as the dollar rose, sectors of manufacturing and agriculture dependent on exports found themselves increasingly under pressure. The paper in general outlines those events of the late 70s, the Paul Volcker narrative.
Old Paul Volcker.
The starting point of financialization, the original sin, if you will. That being Keynesian or laissez-faire market principles combined with high interest rates and a tight monetary policy, which opened up foreign investment. And in order to keep that foreign money flowing in, we kept deregulating, so we could have badass guns and stealth fighters and whatnot. Now that we've covered the primordial soup that birthed financialization, let's cover all the small stuff that really irritates me, and lets us all know that while Reagan succeeded where Carter failed in terms of supply-side economics and really kicked this whole thing off, Reagan succeed, Carter... It's a bipartisan issue. No party has moved to save us from financialization or worked to try and dismantle it in any meaningful way. Instead, in the decades since Reagan, deregulation for the financial sector has only continued, including, our mascot character Paul Volcker being appointed chair of the president's Economic Recovery Advisory Board under Obama. Not only is this a bipartisan effort to feed these flames, every branch has contributed to it. Under Carter, the Supreme Court ruled in 1978, allowing for credit card companies to charge the allowable interest rate in the states in which they were located, leading to a bunch of credit card companies incorporating in South Dakota or Delaware, where usury laws didn't exist. And those are the laws that cap interest rates. Reagan, again, removed the 30% tax on foreign interest income. Congress, under administrations from Carter to Clinton, passed acts allowing for a massive deregulation of finance. Loan interest rates went from regulated by the state level to being superseded by the Depository Institutions Deregulation and Monetary Control Act. Now, to be fair, that one did give us interest-earning savings and checking accounts, but it still doesn't seem like a fair trade to me. The Regal-Neal Interstate Banking and Branching Act was an extension of our mascot character Volcker's decision directing the Federal Reserve to allow bank holding companies to own banks in multiple states. Why I choose to stop in the Clinton administration is twofold. First, I don't want to dig around for more recent examples of financial deregulation, sorting through vast amounts of things that make my hair turn gray. And second, in 1999, Congress passed the Graham-Leach-Bliley Act, an act that drives me up a fucking wall. This act allowed for investment banks, commercial banks, and insurance companies to become affiliates through a single holding company, something we were already saved from and prevented by the Glass-Steagall Act, all the way back in 1933. Financialization didn't just get worse from things that Reagan did, as nice of a lefty narrative as that would be for me. It was something cultivated across not only decades, but political parties and branches of the federal government, aging for rich people like the wines they covet, or the cheeses that they brag about. There's the context, the best that I can present it. Not only has the financial sector boomed, it has consolidated and branched out to seemingly unrelated industries, leading to worse outcomes for many Americans. Will the gold standard save us? I'll probably have to agree with the surveyed economists, despite not being a government advisor, and say no. Is leaving Bretton Woods the reason we're in this massive inequality? Kind of, but there's a lot of factors and events that led us to financialization, including an influx of foreign capital. This influx both staving off the effects of a deficit and making the deficit worse. Those factors compounding to create a political situation where you don't want to be the one to inflict deficit effects on your constituents. Deregulation is the base of this mess, to be sure, and if we put ourselves back on Bretton Woods, some of this can't happen, but a lot of it still can. It may not be the most satisfying answer to say that dropping the gold standard might be kind of responsible for financialization, but I'm not educated enough on the topic to say how much. So I'll work with the language I have and hope to get the point across. If you watched all the way to this point, thank you. And if you were one of the so many people who showed support for my last one, I am humbled. Thank you so much. I really appreciate it. But also, if you got to this point of the video and you have an idea for a question that you think would be fun or interesting, please leave it in the comments. I would love to try and answer things that I find interesting, but if we share an interest, I would be more than happy to do that video as well. Right now, my current leaning is for how a guy from Syria became the first king of Iraq. If you want to know more about financialization, its current effects, and how disproportionate it is to poor Americans, and want it presented in a nice, easy-to-read, short-ish format, Poverty by America by Matthew Desmond is a great read. I tried to use it as a source here, but it didn't quite fit, so I ended up not having it, but I still highly recommend it if there's something that you want to try and be able to do or understand financialization better without reading papers. Thank you so much, and I'll see you next time.